Hello, my name is Richard, and today I'm going to be talking about the Affordable Reserves Calculator. This is the math part of a reserves study, where you'll input the details of all your commonly owned assets. The workbook can do the calculations using both the component method and the cash flow or pooling method. Today, I'm going to be focusing on the cash pooling method, and there's a separate video that concentrates on the component method. The workbook was developed for use with a condo association, but it can also be used by homeowner associations, timeshares, apartment or office blocks, and all types of clubs and societies. The workbook is sold for use at one location only, and sharing the workbook is not permitted. So the first thing to do is to download the workbook from reservescalc.com. And remember, you'll need to have Excel macros enabled for the workbook to function correctly. And then, let's go ahead and have a look. This is what the workbook looks like when you first open it up. There are 3 tabs for each method of calculation: Summary, Input, and Calculations. We're on the Cash Pooling Summary tab, and you can see it has 3 main areas. On the left, Basic Data, which we'll complete in a moment, and on the right, Calculation Results and a detailed year-by-year summary. We'll start with inputting some basic data. First, your property or organisation's name. We'll call it Riverside. Then the current year. The assumption is that you'll put the information in for the current year, and the calculation results will give the funding amount from the beginning of next year. Next, the number of contributors. We'll use 20. That's how many people are sharing the cost, which can be the number of apartments or homes or offices or members. It depends on your organisation. And then the current financial information. Firstly, how much is being contributed to the reserve fund in the current year? Let's say $8,400. This is the annual amount, so if it's paid monthly, it'll be 12 times the number of contributors times the amount paid. This works out, in this case, to be $35 a month. And then the balance at the beginning of the year. This was the money already saved in your reserve fund. We'll assume this was $85,256. We'll come back and look at the rest of the Summary tab later. For now, let's move on to the Input tab. The data needed is pretty much the same for all reserve studies. We'll look at it on the way through. As you can see, I've already input some asset information. You don't have to number the items if you don't want to, but it can be really helpful for cross-referencing to other parts of your reserve study, such as more detailed descriptions, photographs, details of the condition of the assets, or estimates for their replacement cost. Local rules or state legislation may govern what assets need to be included, and you should make sure that you know what the regulations are for your location. So for each asset, you'll need to input some details. First up, an estimate of life of each asset. That's how long it's expected to last from new until it would normally need to be replaced. Then how many years are left. That's how many years there are remaining now before it needs to be replaced. Note that a 0 here means it'll be replaced in the current year, 1 for next year, and so on. Next, the replacement cost. These should be at today's values. Don't try to guess the effects of inflation. Costs and contributions will need to go up with inflation going forward, but you should think about that separately. You can't build those variables into this workbook. Remember, this tab is the important bit. Choose your assets for inclusion carefully. Estimate their lives and remaining lives as accurately as you can, and be realistic with replacement cost amounts. If possible, get professional quotes wherever you can. Finally, see the note on the right. It's a reminder that the data is not yet included in the calculations. To do that, you need to go back to the Summary tab and select the data set to be used. We've input into the original data set. There are 2 columns for alternative options, like maybe including additional smaller items in your study, or planning for next year. So, let's go back to the Summary tab. So on the right there are the options for which data set is included in the calculations. Click on the button to update, and we'll choose the original column. It takes a moment or two, that's machine dependent, and you can see the results updated in the details by year. The first thing you'll notice is lots of negative numbers. That's because no thought has been given yet to how much income we would need to save into the reserve fund each year to cover the future expenditures. You can see this at the top in the calculation results section where the annual and monthly contribution amounts are currently 0. There are different ways to start the process. One good way would be to enter the current contribution level of $35 a month. However, this still leaves us with negative numbers. An alternative that I particularly like, especially if you're doing this for the first time, is to decide how much across all of the years that you would like the minimum balance in your reserve bank account to be. This will be your buffer against anything that might happen in any one year that was planned for a later year. It will be a bigger amount for larger organisations that have more assets and potentially larger values. For this example, let's assume that you think initially that we'd like to always maintain a minimum balance of, say, $25,000. So, in the sensitivities section, you'll see a place to input your minimum funds balance required throughout the study. We'll put in $25,000. And now you'll see the whole thing looking a bit more sensible. This level of funding would require an annual contribution of $11,920, or the equivalent of a rounded amount of $50 per month for each contributor. The maximum balance of funds at any time during the 40 years is just under $170,000, and you can see the large balances build up in 2036 and again in 2050 and 2051, just ahead of large expenditure projections. Those reflect the information in the Input tab, with the replacement of the roof scheduled for 2037 and the elevator replacement or major upgrade in 2052. You can also see that the projected balance at the end of the study is $81,378. The detailed year-by-year results show you the amount of expenditure that's scheduled to happen each year and the year-end balance, all based on the information you input about the lifespan, the life left, and the replacement cost of each asset. So let's have a look at the calculations that have produced these results by moving to the Calcs tab. Here we can see all of the assets and which dataset is in use, in this case the original dataset. It shows each year out for the full 40 years, and at the bottom the total expenditure for each year, the amount contributed, and the running total of the funds. You can see that the balance in each year, less the costs in the next year plus the contribution, equals the closing balance. As you can also see, the amount of funds contributed each year is the same. This is the basic principle on which the cash flow or pooling method is based. Where I live in Florida, the inclusion of any sort of balloon payments in future years, when there might be a larger outlay, is strictly prohibited. Indeed, the Workbook does not allow for balloon payments or any other flexing of contributions, which is totally against the whole idea of spreading the contributions to ensure that funds are available when they are required. Back at the top of the sheet, you'll notice there are percentages underneath the life and cost columns and the column called Exclude. Let's go back to the summary page and explore these options a little further. Firstly, let's consider the assets that you have included on the Input tab. If you've included all of the common assets that will require replacement, then you'll have a range of values. Some people like to save for all of these, while others will perhaps save for the bigger items and just pay for the smaller ones as they occur. You may be subject to local rules or legislation on this subject. We are here in Florida, so make sure you know what the mandatory limits are. Let's assume for a moment that you're subject to regulation that says you must save for all assets that have a replacement cost of $10,000 or more. So let's exclude assets with a lesser value than this. You can put the amount in where it says exclude assets with a replacement cost less than, so that these assets aren't included in the calculations. Or you may not want to exclude them all, in which case put in any smaller value and see what effect it has on your future payments. This hasn't changed the level of contributions, but it has affected the funding level, larger balances being saved. Pop in the $25,000 minimum fund balance again and you'll see the level of contributions come down. Let's look at the effect on the Calcs tab. All of the excluded assets are marked with an X. You can manually adjust your exclusions here, adding or taking away X's. And you can start here if you want without having any input at all on the Summary tab, inputting all of your exclusions manually. Do note, however, if you put 0 in the exclusions on the Summary tab, it will clear all exclusions, including those that you have put in manually. So this is a method of fine-tuning your payments by adding or subtracting some of the smaller value assets. Next, let's think about your life and cost assumptions. When estimating life expectancy, one person will base assumptions on early replacement, while others will assume life can be stretched out until an asset actually breaks. Similarly, when estimating replacement cost, some people will quite naturally assume that list price is good, while others might fancy their negotiating skills and estimate lower costs. With the increase and decrease percentages, you can flex these calculations to test the assumptions. Let's just put the workbook back to having no exclusions and a minimum fund balance of $25,000. So, looking at the asset life first, let's assume you based all of your input on extending all of their lives as long as possible, and that you think that perhaps they may be a little over-optimistic, maybe by 10%. So, instead of the 10 years you input, 9 years might be more realistic. So, put minus 10% in the life expectancy. Immediately you'll see the funds drop to negative numbers. So once again, set the minimum balance to $25,000 and see what it does to the contributions. They'll go up from $50 up to $57 a month. Reset the workbook again, and instead let's look at the replacement costs. Are they at book value? Are you a great negotiator? So let's reduce the replacement costs by 5%, and this time you'll see the funding increases. So input $25,000 minimum again, and the contributions come back down to $47 a month. So by flexing these options, you can fine-tune your reserve study finances to achieve an affordable contribution, saving for appropriate assets, and test the sensitivity of your assumptions. And finally, on the Summary tab, you'll see the buttons for increasing and decreasing the number of lines of calculation. The workbook is initially set up with 20 lines, and you can increase this 5 at a time up to a maximum of 80, and you can decrease them in the same way. Do note, however, that any data you have in the lines that you delete will be lost and cannot be recovered. Well, that concludes our look at the Affordable Reserves Calculator. And just to let you know, as well as the other 3 tabs for the component method of funding, there is one other tab outlining the terms and conditions. I hope that you found the video informative and useful, and that the workbook may be just what you're looking for as part of your reserve study. And as a final reminder, the Affordable Reserves Calculator can be purchased and downloaded from reservescalc.com. Thank you for watching.